Ladies and gentlemen, thank you for joining us today for this important discussion about the Israeli economy at this challenging time. My name is Natalie Raz, and I'm the CEO of the Israel Hedge Fund Association. At the Israel Hedge Fund Association, we see funds and investors alike and felt it was important to gather the Israeli economy leaders and hear their views at this time. Despite the challenging circumstances of wartime, it is a testament to the resilience and determination of our nation that we gather here today to discuss the economic outlook and strategies to navigate these turbulent times. As we confront the complex and changing dynamics of conflict, it becomes imperative to underscore the importance of a robust and adaptive economy. We understand that a thriving economy is not only a source of prosperity for our citizens, but also a source of strength that enhances our ability to weather storms. Israel found itself in this war with a strong economy that did well throughout crises like the financial crisis in 2008, COVID, and during periods of local tension. This is also true today. Immediately after October 7th, the Israeli banking system, as well as the institutional market, did not stop for a minute. Investments and transactions are ongoing, and financial ecosystem is up and running. We acknowledge the sacrifices made by our citizens, businesses, and public servants during these trying times. Our thoughts and our hearts are with all of those affected by the atrocities of October 7th and current conditions. While nothing can alleviate the suffering of those who endured, we are committed to making sure our economy emerges stronger and more resilient than ever before. I would like to thank the Tel Aviv Stock Exchange for the collaboration and our speakers today, who are leaders in the Israeli economy. A special thank you to the Governor of the Bank of Israel, Professor Amir Yaron, for his crucial role and contribution to the Israeli economy, especially during these challenging times. I wish us all an interesting market update and discussion. We hope for better and more peaceful days ahead. It's my honor to invite Professor Amir Yaron, the Governor of Bank of Israel. Thank you.
All right. So first of all, to everyone, good afternoon or good morning, depending on where you are. As we're all aware, Israel is currently at a war following the October 7th inhuman, brutal attack by the terrorist organization of Hamas. This is a crucial time for Israel's security, and we thank all those who support us. Our hearts are with the innocent victims of the war, and our hope is for it to end with the safe return of the hostages and with peace and security. What I want to talk in terms of economics, I'll try to present briefly the Israeli economy, its strength and its resiliency, kind of its foundation. Within it, a little bit of into the high-tech sector. Then I'll talk a little bit about inflation, and then basically development or economic developments since the war, and a little bit at the end about outlook. So why don't we start? So first of all, Israel has shown a lot of resiliency and very high growth, including COVID. So you could see in COVID, we had a relatively mild drop if we compare it against the rest of the world. We basically had a contraction of about 2% and then immediately grew out of it and have been almost 8 quarters above our trend. Just to give you a flavor, we grew over 9% in 21, 6.5% in 22, and we're on a rate of growth to be before the war around 3.4, 3.5 in 2023. I would roughly say we were on a way to very, very softish landing in terms of both inflation, and I'll show that later, and growth. Just like many other countries, very tight labor market. That was slightly towards the end, was moderating, but still very high, very low levels of unemployment, very high participation rates, still way above pre-COVID period. Israel has shown, this is basically the debt to GDP of Israel. And you could see that over the years up to COVID, we have shown very strong and responsible trend of reducing our debt to GDP. Prior to COVID, it was just around 60%. During COVID, it went up to just around 72%. And then immediately following in 21 and in 22, we dropped back to pre-COVID level of 60%. So maybe to sum it up, prior to October 7th, the Israeli economy was in, by many metrics, very good standing, low debt to GDP, expected deficits in 23 of about slightly above 1%, relatively high growth within a global economy which was slowing down. And I'll show you the numbers about inflation. In terms of debt to GDP, you could see where we are roughly in the cross section of OECD countries or a broader set of countries. And this is something that I'll get back to with the increased basically costs that are associated with the current war. Something about I've talked about our resiliency and our ability to come back and back again after various crises. Clearly, a leading sector in Israel is the high-tech sector. It is very important for the Israeli economy. You could see it's over 50% of our export. It's about 17% of GDP. Probably those high numbers of growth that I've shown you, a lot of it, 40% in the last 5 years, is due to the sector. 25% of taxes paid by that sector, and it's a growing percentage of our overall employment. So a few maybe perspectives on funding. So first of all, in blue, you could see as percent of GDP. Again, we are an outlier. If you think the US is a high tech, it has a lot of high tech, you could see that as percent of GDP, Israel has a very high percentage. That's on the left-hand side. On the right-hand side, you could see the progression of funding through the various years, where the bottom red line is basically kind of 2015 to 2019. The years post-COVID were just an immense growth in funding. We all know that somewhere around mid-2022, funding to growth sector has slowed down. And we're seeing that segment in green at the bottom is kind of back on track where it was before. And of course, this funding is important as we go forward. Something about the difference between 2001, when the dot-com blew, and the current situation of the high-tech sector. The main point I want to make is that our current high-tech sector is much more formidable, much more diverse than what happened in the dot-com in 2001/2003. I don't have that graph with me, but if I'll show you the biggest drop that we had in GDP per capita, it was actually during the 2001-2003 event. Now, back then, most of our high-tech sector was concentrated in telecom. Most of the business was relatively immature, dream companies. Whereas right now, you could see by this pie chart, first of all, it is much more diverse. The companies are a lot more mature. And on the right-hand side, you could see many of them, approximately 60% of them, have some kind of a released product. At least holding everything else equal, this is a much, much more mature segment. It has a lot more access also to funding, and it's diverse into also, of course, we're extremely well known in our cyber, fintech, and medtech, but these other sectors, as you could see, are also growing sectors within our high-tech segment. A few words, I'm a central banker after all, so I'll say a few words about inflation. First of all, Israel pretty much all along was at the bottom quartile, even at some periods below the bottom quartile of inflations among the OECD. And you could see that on the right-hand side, our current inflation is 3.7. We peaked at 5.4 in January 2023. On the left-hand side, you could see that if you look at inflation, some measure of core inflation, if you exclude food and energy, we're around 3.2%, still at the bottom quartile of the OECD. This is the kind of breakdown of inflation in Israel. Of course, it has similar components to other countries. What I want to focus on is the next graph, which decomposes it into tradables and non-tradables. We are a small, open economy, after all, and we are obviously affected by global conditions as well. So a lot of people talk about the stickiness of inflation, and that's, I would say most of the stickiness is in the non-tradable goods. That includes also shelter costs, which are about 25% of the CPI in Israel. But the good news there is that you see that that orange line, while it's still at 4.2, it is trending down. We are seeing shelter cost coming down, and to us, that is a very good sign. The tradable parts, the blue part, obviously is relatively highly affected by the exchange rate and energy prices. And given the depreciation that we had lately and some changes in the energy prices, we've seen it pick up. It's still not much lower than the non-tradables, but it has picked up due to these effects of the exchange rate and energy prices. Where is inflation expectations? For us, it's not just, and we always do this in the central bank. We're not overly dazzled by a good number, and we are careful to analyze basically the dynamics of inflation. I don't have it here, but if you look at our publications, we look at the 3 months inflation, the 6 months inflation. We want to see where is the dynamics of the inflation going. What you're seeing here is on the left-hand side, the basically inflation forecasts of 14 forecasters that we kind of monitor. And you could see that roughly towards the end of the first quarter, maybe beginning of second quarter, we are going to be in the target of our inflation. The inflation target in Israel is between 1% and 3%. And so inflation is anchored. On the right-hand side, you see market expectations, both by the forecasters and the break-evens, that is between real and nominal bonds. And you could see they're all anchored somewhere around 2.4 and 2.5. And that is very important in terms of looking forward to where inflation is going on. However, these are the means of the expectations. When I'll get to the part about the war, clearly there's been some very strong supply shocks, such as in the construction and agriculture industry, on the negative supply shocks, as many Palestinians work in these industries. and foreign workers. And on the other hand, there are also demand shocks, such as tourism and things like that. So this is where inflation expectations are. But even the developments of inflation, we still need to see how did they develop given these different types of shocks that the market or the economy is undergoing. This is basically the current interest rate, both by the Fed, Israel in blue, and the ECB. We are a small open economy. Sometimes we deviate very much from the major banks. If I've given you a graph over time, you cannot probably deviate forever from the effects of the global economy, but this is a balancing act that every country needs to do what is appropriate for its own country. The monetary transmissions are different. One very clear example that I always give is mortgages. In Israel, most of the mortgages are variable rate, which means when you hold everything constant, every 1% raise in interest rate is much more effective. It affects the whole stock of mortgage takers, as opposed to, say, the US, where most of the mortgages are fixed rate, and so it mostly affects those that are the new mortgage takers. And so all these changes are taken into account by the bank when we make our decisions. Just to say a little bit about our actions, what you see on this graph on the x-axis, you are seeing number of months since inflation exceeded the upper limit of the inflation target. And on the y-axis, you actually see the interest rate minus actually realized inflation. So this is not really the real interest rate, but it's some kind of a notion of how restrictive the central bank has been and how quick and determined it has been. So for example, in green, where you see the US at around -8, that's when the interest rate there was about 1 and inflation peaked at about 9. So you could see how long of a detour it's taken. Clearly, they're in a restrictive zone now, according to this measure. We've acted, first of all, very quickly already in the summer of 21, stopping summer towards fall of 21, blocking or stopping various special loan programs that we had for COVID and our QE program. And you could see, given our inflation rate, this has been a very determined approach to averting inflation from becoming too high, which at which point the cycle can become costly to avert. Something about the exchange rate. I would say the exchange rate during 2023, as you can kind of divide it into several segments. I would say, first of all, during 2022, once tech stocks have taken a beating and Nasdaq has taken some of beating, it was natural that the shekel also depreciated. So what you see here is that until the beginning of 2023, the shekel was very tightly linked to Nasdaq, and that is a feature that our institutional investors, pension funds, etc., invest quite a bit abroad. And so when Nasdaq goes up or S&P goes up, marking to market, they make capital gains and then rebalances to shekel or vice versa. What you are seeing is that post or around January 23, you could see that the orange line sort of start departing. So the orange line is what the exchange rate would be predicted by Nasdaq, and the blue line is the actual exchange rate, and you could see they departed. And so the shekel kind of started to move towards the region prior to the war around 385. And that was, I call that an excess depreciation due to some of the issues we had with the changes in the judicial system. And then you could see the big spike there right at the beginning of the war. And then you could see in blue that it came down. And I'll explain what we've done since the beginning and some of the steps we've undertaken. So kind of the stories during the year have had different components and explanations to them. So let me talk a little bit about the developments since the war. So one important, especially for investors, one important point to make: Israel, unfortunately, has seen many military events and operations and wars. And the one thing that comes out is that pretty much after every single one of them, Israel has known to come back, and these are quarterly growth rates, and has essentially had bounce back and has had large growth after these events. And there's no reason to think this will not happen also in this case. So this is, I think, especially for you, if you look at the fundamentals that I've already explained, if you put COVID there as another crisis, you add all these things together, it basically tells you the Israeli economy and what I've said about the high-tech sector has these fundamental features of being able to come back and grow very, very fast following various crises, and in particular, military ones. What has happened to, this is the nominal exchange, this is the effective nominal exchange rate. And you could see this is an event study given several military events. The vertical black line is the 0 point where they started. You have 30 days before, and you have 60 days after. You could see that the current event, the shekel has depreciated a lot more, relatively speaking, to other events, probably internalizing the fact that this is a larger event. We've started it obviously with penetration to Israel, and with obviously all the numbers that you've seen in the media about people murdered, etc., and kidnapped, and probably also part of the weight being on a fear of whether this will be a multi-frontier war. As things stabilized, you could see that the exchange rate right now is even below where we started. I told you on October 6th that the dollar shekel was at 386. It's at now, yesterday it was at 3.7, depending where you look. So these probably also reflecting that some of those, at least some proponents in the market are talking that these issues that I alluded to earlier about the judicial issues are probably off the table. And the fact that we've made good grounds in terms of some of the military issues, and that the likelihood of a multi-front frontier has decreased. These are some of the steps that we've undertaken during this event. And I want to point out, if there's one lesson from economic history, you don't not want a crisis, an event. If we take the COVID example, you do not want a health crisis to become an economic crisis, to become a financial crisis. Once it becomes a financial crisis, the domino effects become a lot larger, and basically the costs become much more formidable. So already, and analogously here, it was very important for us to stabilize the markets very early on, and we did it on October 9th when the FX market opened immediately after the October 7th. And what we did is we basically created a program where we would sell up to $30 billion in reserves, a $15 billion swap transaction. And we set out right. We don't target it. We didn't target a particular FX rate, but we wanted to make sure there's enough liquidity, there's enough stability, there's not a sense of panic or overshooting, that the market functions fundamentally well. We also opened the stock market, as was mentioned, the stock market on Sunday here. And the main point was this effect, I believe, and had a periphery effect, not just on the FX market, but on the bond market, on the stock market. They all performed and functioned accordingly afterwards. We also created a repo transactions for institutional entities. I would say the one thing we added at the end, about a week or so ago, is low interest loans to banks, conditional on them providing credit to SMEs. Those are the most vulnerable firms, and this is something where we give the banks a little bit a rate that's slightly lower than the Bank of Israel rate, provided they pass that on to the SMEs. What we've done, so it was very important for us, as long as risk premia is high, and is to really focus on market stability, and we're still very highly focused on that. But on the other hand, and this was the two-pronged approach that we've taken, was to provide certainty for the people around the border that got hurt, the many people who got called for reserve duty. And so what we've done together with, we supervise the banks, what we've done is we created a program for deferring loans, free of interest, free of fees, to the victims and reserve soldiers for at least 3 months. We did it also within, I think, by October 10th or so. And so that was very important to instill certainty and for this set of population, to make sure that there's certainty on that side. One can think of that in economic terms. So this is for mortgages, for consumer loans, and again, for some SME loans. And one can think of this as almost targeted, very, very targeted interest rate easing for this particular segment. And then one of the issues that I do as the governor, which is the last point on the right, is the economic advice to the government. This is something most central bankers don't do, and we are very involved in part of the fiscal support that has been given to the various firms, etc. So what has happened to the stock index in Israel? So the year to date, you could see on the right-hand side, has not performed very well, but you could see that since the 7th of October, we are still an outlier, but since the 23rd of October, where things, at least militarily, and the markets have somewhat started to come down, you could see that Israel has been a top performer in terms of the stock market. Over here, you see the CDS, the 5-year CDS of Israel on the right-hand side. It jumped, and initially, and after 2 weeks or so, it stabilized, and it's actually came down somewhat. You could see it on the left-hand side with the blue number. You could see the spread between Israeli 10-year dollar-denominated government bonds and U.S. 10-year Treasury bill. You could see that also went up, but has come down somewhat. It is still at elevated numbers, reflecting the fact we are still at a war. So there's still large uncertainty, but we haven't seen it. We've seen it sort of slow down and come down somewhat. And you could see in gray on the left-hand side, this is the 10-year Israeli shekel nominal yield, since we're going to have to increase our local debt as well, and we have large institutional market that can absorb, I believe, can absorb it. And you could see it hasn't gone up by any discernible means in any way. Most of our debt is still in local currency. What about inflation expectation? Long one. So here you see the 5 to 10-year inflation expectations. This is again an event study. You don't see a big change here. This is probably reflecting again that we know how to manage this economy. The economy can come back, and this is very important. In terms of corporate spreads, yeah, they did go up initially, and then they basically came down, except the construction, some segments within the construction industry that are still somewhat elevated. They are almost pre-war levels. What about the real activity? One quick measures of real activity is credit card expenditures. Just like in COVID, they in gray there on the right-hand side, it initially dropped by almost 25%. You could see at the very tail end there, we are back to 96%. There are some segments like tourism, other maybe theaters, etc. It will take them a little bit longer to come back, but this is reflecting the fact that the economy, and anybody who spends time in Israel, you could see it, restaurants, you could see it by congestions on the roads. People are back, the economy is refunctioning again, and this is a very quick and important measure for us. A few words about the outlook. The expenditures that, where's our estimate of, so let me first start with this. We are, our estimate for GDP growth for this year is to end at about 2%. The 2.3 there is our previous estimate after the war. But as I mentioned, we were on a track of a 3.4, 3.5 prior to the war and slightly above 3 for 2024. This is our current estimate under the scenario in which the war goes on still into 2024, but then at a slower and slower intensity as we go and continue into 2024. And it is primarily in the southern region. You could see the other numbers there. The wide unemployment rate includes those that are laid off to paid on leave with unemployment benefits. So this is why the numbers are higher than the numbers you've seen on the second slide on unemployment. And you could see where we expect inflation to be sort of at the average of the last quarter of 23 and 2024. The important number is the debt to GDP ratio. I'd like to focus primarily on 2024 because 2023, there are many ways on how exactly the receipts will be accounted for in 2023. What we see is basically debt to GDP growing to 66%. Basically, the breakdown that we are seeing in terms of the cost of the war is these are expenses that are going to laid out between 23 and 2024. You could see they include obviously security issues, compensations for damages, other civilian expenditures. Just like in COVID, we support firms in various ways, and then slightly higher payments on the increased government debt. And then, because of the slower economy, this is loss of tax revenue relative to where estimates were before. This is broadly the economic breakdown of the economic cost of this war, or the fiscal cost of this war. And this is about 10% of GDP. In terms of loss of GDP, it's about a cumulative loss of 3% of GDP relative to that first graph where I show you the level of GDP. So going forward, and basically this is Israel's military expenditure in Israel. You could see it's naturally high. It's about 4.2% relative to GDP, relative to, and you could see it's high given our geopolitical issues relative to other countries. And yet, on the right-hand side, you see the civilian public expenditure in Israel is not that high. So the real question going forward is to make sure that we make the appropriate adjustments in public spending, so that somewhere in 25, in 26, debt to GDP starts making an inverted U shape. And in order to do that, we will need to make adjustment because probably security cost will have to increase on a more permanent basis. And basically the 2024 budget will have to be reopened. And we have ongoing discussions with Ministry of Finance and the rest of the government. And we will have to come down with some adjustment that will have to focus on areas where, let's say, they are less supportive in terms of engines of growth, and to do the adjustments right there, so as to make sure that over time, as we come back and grow in 25, as I've shown you before, this debt to GDP sort of reverts back towards the 60%. And I believe these are manageable things that the government can do. And we will probably have to do them in the next month or two. I think people in the government understand that some of these adjustments will have to take place, and they will have to reprioritize maintaining as much as possible growth engines in terms of the budget, and on the other hand, take out in particular some permanent components that are less needed in order to compensate for this partly temporary growth in debt to GDP and the longer increase in security cost. We in the BOI, obviously in the bank here, will continue to do our job. You saw that slide. I wear three hats: monetary policy, bank supervision, and of course, economic advising to the government. You essentially heard my speech and advice on the fiscal side, and I believe this will be the work that will have to be carved out in the next month or two. On the banking side, the banks here are very stable, very formidable, and that's why they can actually do all these deferrals. They have all the capital buffers to do those things. And then on the monetary side, in view of the war, I'm just basically telling you our the statements that we just made this week in terms of the interest rate decision. The monetary policy is focusing on stabilizing the markets, as I've shown you, and reducing the uncertainty. But this is alongside price stability and supporting economic activity and growth. It implies that the interest rate path will be determined according to the developments in the war and in the uncertainty that is, inevitably connected with it. But as long as, and in so far as recent stability, and we've seen that stability come back in financial markets, becomes entrenched, more entrenched, and inflation environment continues to moderate as we expect it to be towards the target range. Basically, our monetary policy will be able to focus more on supporting economic activity. I'll stop here. Thank you very much.
It's my honor to invite Mr. Itai Ben-Zeev, the CEO of the Tel Aviv Stock Exchange. Please.
Hi, everyone, and thank you very much for joining us today. Before I dive into the Israeli capital markets, we're going to have later on Nati Ginor from Jefferies heading the investment banking activity of Israel. I wanted to convey my sincere thanks for Jefferies for the outstanding donation that they've made, $8.6 million for humanitarian aid after they saw the atrocities that Israel went through. They made a very significant move, giving this huge amount to 10 charities in Israel for the best purpose it can be. So thank you very much for your continued support. The Tel Aviv Stock Exchange has equities, debt, derivatives, and all kinds of products. And I'm going to start my presentation by showing you our equity market. We obviously have a strong equity market. All of the numbers here are as of 31st of October, 2023. We have 538 listed companies. The market capitalization is $213 billion US, free flow 62%, and the total equity capital that was raised since the beginning of 2020 until the end of October 2023 is $21 billion. On the right-hand side of the chart, you can see that our companies are well diversified. We have, I think, all of the segments that you can imagine. Our three leading segments are the high-tech, around 30%, real estate, and financials. And I think that it gives a solid exposure to the Israeli economy. When you look at our leading indices, in the 2020 and until the end of 2022, actually our leading indices were among the leading in the world. The TA90 actually outperformed even NASDAQ and S&P 500. Clearly, 2023 was a complete different picture. Even though it seems ages ago, until 2 months ago, everyone in Israel was in discussions all the time about the proposed judicial reform. Actually, since January 2023, when the judicial reform came to our life, that was the main theme, not only about Israeli politics but also in our capital markets. We saw a continuous shift of funds, both from institutions and also from accredited and retail investors, moving funds outside of Israel. And clearly, it had a very negative impact on our leading indices. As you can see, this year we are far away from what happened in the world, but you have to remember that our economy, our country actually went through two extreme events. One is the judicial reform that clearly, when the war started, it became irrelevant. And the second event is the war itself. Following what the government has demonstrated, I want to give you one example of the actual effect, because in Israel, unfortunately, we have a lot of experience with war, and we all hope that one day it will be completely irrelevant, but first we have to make sure that our borders are safe. And we chose one example of the Second Lebanon War. You can see in the chart that it shows the TA-125 since June to December in 2006. You see when the Second Lebanon War started, in the first two trading days, the TA-125 went down by 8.2%. After 40 days after the war began, the index came back to the same position, but throughout the rest of the year, the index rose by roughly 10%. And this is a good example of what the government talked about it, that usually in the world, and specifically in Israel, after military operations and wars, because of the resilience of the people, the good fundamentals of our economy, our indices performing well. In the current situation that we are having since October 7th, you can see that in the first couple of weeks, our TA-125 went down by 13.5%. It almost returned all of it. According to the closing of yesterday, we were only 2.7% lower, and today the market continued its progress, so this number is even lower. And we believe that as long as things will be under control, our market has a long way to keep performing well, given all of the strong fundamentals that we have. We also have a very strong and deep ETF market. We have overall 81 ETFs that are being traded on the Israeli equity indices. You see on the left-hand side that the public holdings in total of all of those ETFs currently are more than $11 billion, and it shows the depth and strength of our equity market. Moving to our debt market, in Israel, we don't have OTC trading in bonds, but bonds, both government and corporates, are being traded on the exchange as if they were equities. So when you look at the government bonds, according to WFE publications, our exchange is the second most active electronic exchange for government bonds in the world. The aggregated market cap is $146 billion. The ADV, the average daily volume, was since the beginning of the year until the end of October, $735 million, and we have 35 bond series. Moving to the corporate bond, where we are the fourth largest trading volume venue in the world, the total market cap is $104 billion. The average daily volume is approximately $300 million a day, and we have 732 bond series. In the corporate bond issues, clearly TASE is a central source of financing for Israeli companies. We have also companies that issue debt even though they don't have their equities being traded in the exchange. You can see that in the past few years, we've had between $20 to $30 billion a year in issuance. And most of the issuance is through the general public offering, but we also have a small bit in the platform of TASE, which is actually our private market that only institutions and accredited investors can tap in. And we believe that this platform will continue to be an extremely important, not only in times of war, but also in times of prosperity and the positive functioning of the war. If you look at the government bond issuance on TASE, clearly in 2020 and 2021, there were very substantial amounts of issuance. You can see $38 billion in 2020 and $32 billion in 2021, clearly because of the COVID. 2022, we went back to $12 billion. And in 2023, since the war began, the government already issued approximately $6 billion and counting. All of the issues that took place in the past 8 weeks was very successful, both on the demand side and also if you look at the spreads. Overall, you have to remember that we have institutions that have a lot of money in Israel. The general public has a lot of money. I will show you at the end a slide about it. So the government has the ability to continue to raise substantial amounts of debt, which is clearly very important. And as the government demonstrated before, our low debt to GDP is a very important factor going forward. Also on the debt side, we have a very deep and diversified ETF market. We have approximately 140 ETFs that track Israeli bond indices. The overall amount of public holdings is around close to $8 billion overall, and this is also something that gives a positive momentum for this market to continue and evolve. I want to talk really briefly about the market potential. I think that everybody saw from the presentation of the government the resilience and the depth that our economy has, and why we are all optimistic that our economy will continue to prosper. But when you dive into our capital markets, clearly we have many things that we can leverage and continue. And I want you to have a look at the 125 US billions money of retail in Israel sitting in checking accounts. When you look at our economy and you compare to any other Western society in the world, you see that the amount of money which is ready to invest relatively to the size of the economy of the GDP is the highest in any Western economy. One of the reasons is that even though our economy has progressed, our capital markets and the understanding of the retail and the way it's being distributed is not developed enough. And hence comes the opportunity for the market and for individuals to invest not only more, but also to start invest and have exposure to our equity market and to our bond market. And we believe that this is one of the growth engine of our market. We have seen through the COVID many individuals that opened accounts and started to trade. And the few brokers that we have in Israel have demonstrated a very significant growth, but still, when you look at the overall numbers, we are far below other economies. The second element that I want to highlight is, given the high rate of saving of the Israeli public, our Israeli institutions have a lot of money, not only the AUM that they run, but the constant inflows that they're getting every month. In the past year, a lot because of the proposed judicial reform, the majority of the inflows went to invest outside of Israel, whether it's equities, debt, alternative investment, real estate, whatsoever. We have seen in the past few weeks a major change in the behavior of the Israeli institutions, not only because they are accustomed to military operations and war in Israel, but also because they understood that the judicial reform that was a major concern became irrelevant, and because when you look at our TA125 multiples compared to other markets, we are cheap, and also because of the understanding of the history of what happens after the war is concluded. So if you look at the Israeli institutions, until the war, they invested only around 3 billion shekels in our equity market. Since the beginning of the war, they already tapped this number. They already invested more than 3 billion shekels in the equity market. And of course, we have other investors and international investors, but we see a significant change. And for us, this is part of the market potential going forward. And being the startup nation, clearly, we have more than 300 Israeli high-tech private companies that their theoretical market cap is $50 million and above. So when you look not only on the strong resilience of our market, but also on the pipeline and the companies and the interests that we can accumulate all together, we are optimistic about the future growth of our market. Thank you very much.
Thank you, Itai. For the allocators panel, how to react to a national emergency, I'm handing it over to the moderator, Nati Ginov from Jefferies. Please.
Thank you, Natalie. And Itai and Professor Yaron, thank you so much for having me today and for providing those perspectives, which are incredibly valuable for our global audience. My name is Nati Ginor. I lead the Israel investment banking team for Jefferies. We have 12 people dedicated to Israel across investment banking, global equities, fixed income, and wealth management. Today, we cover 45 Israeli companies and research, and we see a tremendous amount of opportunity in the Israeli capital markets. For the discussion today, I've had the good fortune of considering both Erez Migdali and Ron Senator friends and clients for over a decade, and I'm grateful for the opportunity to moderate a discussion with them today so that we can all benefit from their unique perspectives on the Israeli market. Erez, we'd love to see you as well. So Erez, Ron, I'd like to actually start with each of you taking 1 to 2 minutes to introduce yourselves for the benefit of our global audience, provide a quick overview of your respective institutions, Migdal and Sfera. Additionally, if you could take the opportunity to provide a brief perspective, the backdrop of the Israeli capital markets. I know we heard a good amount from Itai and of course from Professor Yaron, but a bit about some of the unique drivers of the domestic market. I believe that that will serve our attendees very well. Because I don't see Erez on, Ron, maybe we'll start with you. And then we can kind of hand it over to Erez after that.
Sure. Okay. Thank you very much. Good morning or good afternoon. Thanks for having me. I'm Ron Senator. I'm one of the co-founders of Sfera Funds Management. We've been operating since 2004, so that's our 20th year. And maybe just a quick background: we manage a number of hedge funds across a number of strategies, and our primary fund has been sort of Israel equities, which is focused on covering and investing in Israeli companies, Israeli stocks. Most of them are listed here in Israel, and some of them are listed internationally, anywhere from sort of value-driven businesses to growth companies. And I think the primary objective is obviously to identify and invest in good quality businesses that generate appreciated value over time. We're long biased fund with sort of a long-term horizon. Maybe a few words on sort of the maybe dynamics of the Israeli capital markets. How do we view it before we switch to Erez? We look at the Israeli capital market as a very, I would say, institutionally driven marketplace, where I guess the portion or the trading volume and float held by institutions is quite heavy compared to other markets. Retail participation is probably less felt or less meaningful. That creates a more, I would say, stable environment, more visibility, stable sort of capital inflows. The nature of the market is such that obviously you see a sort of incoming sort of month-to-month capital inflows, which again create visibility and provide a fairly attractive sort of investment background over time.
Perfect. Erez, over to you.
Hi, Nati. Thank you, and thank you for inviting us to this panel. My name is Erez. I'm the CIO of Migdal Group. What else could I do with a family name like this? Migdal Group manages today about $100 billion US. We're part, like Ron said, of the growing industry of Israeli institutional investors. The industry manages today roughly $600 billion. It's growing quite nicely, 10% per annum, mainly thanks to Israel's young demographic and the mandatory savings plan that we have in Israel. We came into this war with portfolios that are highly diversified. Exposures for global assets invested are roughly half of the portfolios and was growing in the last couple of years. And also increased allocation to alternatives, infrastructure, real estate. And happy to be on the panel. I think it's a good opportunity to shed some light on what's happening on the ground and what we are doing, not just what we see on the screens and social media.
Okay, so thank you both. And I think we're fortunate to have both of you here as experienced investors who have been institutional Israeli managers for decades. And as such, neither of you is new to managing capital in periods of uncertainty, volatility, and unfortunately of conflict. Because we have two different strategies here, one long only and one hedged, maybe we can begin with the outlooks that you both share on the long side. And then Ron, maybe you want to provide a bit of additional perspective on either hedging views in this environment, et cetera. But Erez, to you first. How have you been investing on the long side in recent weeks amidst the current conflict? Have you been viewing this as a buying opportunity? Have you been thinking more about protecting the downside? Are there any sectors that you've been focused on as opportunities near term? Would love to hear a bit of how you've been spending your time in these last several weeks on the investing side.
Yeah, so thanks. That's a good question. And I think the starting point really matters because in terms of the market, valuations were quite low. Itai spoke about it, but the judicial reform and the concerns surrounding it made the Israeli market underperform international market. So that was one setup that we entered into the event. And from our perspectives, portfolios, like I said, were really diversified with half of the assets invested globally. So we had the capacity to invest and to take risk during the crisis and the first couple of days. We have focused more on the equity side. This is where we saw the opportunity. One of the key sectors in the market are the banks. There we saw a combination that we believe enjoying favorable valuation coupled with very intense and selling pressure that we saw in the market. It's one of the favorite sectors for foreign investors that we're selling, and we increased allocation to this sector. Another area where we were active is the real estate sector, especially focusing on subsectors that we think are enjoying good secular trend, like logistics and residential, along with some stock picking in the shopping centers stocks. We think that coupled with low valuation, we see the scope for easing of the monetary policy down the road, starting maybe in the Q1 of 2024, and that will be favorable also for that sector. In the perspective of the whole portfolio, we have trimmed a bit positions where we were holding as a liquidity or as a buffer in the portfolio, like short-term bonds in the US, and that was a source of capital and redeploying it to the Israeli market.
Thank you. And then Ron, anything from your perspective, either on the long side or how you've been thinking about hedging in the last several weeks?
Sure. So as Erez mentioned, I think also Itai touched on this earlier, during October, the first couple of days after the war started, there was very heavy, indiscriminate selling pressure, mostly by, I guess, by foreign capital, by international investors. Market was down extremely hard. Certain sectors were down 15, 20% over the course of the first couple of weeks. And that in and of itself created the very compelling buying opportunities. Banks is obviously one example. There's also a notable example of international businesses, Israeli companies which are selling globally and are listed here or in the States, doesn't really matter. Just by being associated with Israeli companies, they were down also 15, 20% easily. A lot of them multi-billion-dollar market cap names. And obviously that was a clear buying signal for us, given that their end markets were less affected, less sensitive by what was going on the ground here. So that's one example. And again, there were more than a number of other stocks that were just sold off, irrespectively of their business sensitivity. So that's on the long side. On the hedging side, obviously we use hedging as protection, as downside protection to the portfolio. Either we use options, pretty frequently as sort of as an insurance policy, if you will, or just individual shorts, or there's another tool which is basically not hedging our US dollar holdings. Again, owning dollars in a shekel environment is also a natural hedge. So this is the combination that we use.
Perfect. Thank you. So look, we've heard from Professor Yalon and from Itai about the resilience of the market. We've heard comments from you both. I think we see it in the shekel. We see it in the TASE indices. Such periods of conflict provide obviously local and global investors in the TASE opportunities, as we've just discussed. In your view, is there a difference in your mind investing during this particular period compared to past Israeli conflicts, either with Gaza or otherwise, whether it's Operation Protective Shield in 2014, but just in general, how do you see this current investing environment as different from ones in the past where you've had to navigate such conflicts? Why don't we start with you, Ron?
Well, each conflict or each war is probably more. It's never the same. But obviously, we start as a basis. We start with precedents and historical sort of events. So, as was mentioned here, each and every military conflict in the past basically proved as buying opportunity. This one, I think, not only in hindsight, but also from the get-go was somewhat more complex, given I would say the various scenarios that could transpire here. And I still think that this particular war is somewhat different than what we used to or what we saw in the past. And I think from that angle, we need to be somewhat more cautious. But if you, again, review the extent or the hit to the market in the first couple of weeks, it was almost disproportional to what was happened in previous conflicts. The market was down, again, 12% in the first month. It's way heavier or more severe than what we saw in previous conflicts. So in one respect, we are buying more and trying to take advantage of what the market is giving us. On the other hand, we need to be more cautious and hedge more. And I think some of the way to do that is through our, say, globally sensitive companies, not just domestic businesses.
Makes sense. Thanks. Erez, would love your perspective as well.
Yeah, Nati. So I think that the scale of the war could be different from past conflicts or episodes that we have experienced. So the time that it will take and the probability or the risk of further fronts, mainly in the north, that we can see. So that is a source of risk that we manage in the portfolio. For us, as we operate on the long side, it means acting more gradually and expecting that we would have more volatility down the road. And we think that it would be a risk in the coming month that we will have to monitor in the context of the portfolio. Another factor that we believe will play out is that the cost of the war can be significant, much more than previous conflicts. It is something that is manageable. The governor has shown in his presentation that the starting point of debt to GDP in Israel is very, very favorable. So it can be managed, but we do expect higher issuance of bonds from the government. And as a multi-asset portfolio, we think that there is a scope to increase allocation to local bonds relative to what we have been holding. But we expect the equilibrium or the interest rate to reflect the risk and also the scope of the scale of the issuance. And in the context of the portfolio, we think that it would be increased in the expense of some of the global fixed income that we hold. I think 2024 would be a period of adjustment that the players in the market would have to absorb this issuance. It could be done, but it would take a shift in allocation of the local institutions.
Okay, thank you. So, look, because of our very strong belief in the resilience of the Israeli economy, and I guess as an investment banker, I have no choice but to always be optimistic. Let's for a moment talk about something else. There's a difference between investing during a conflict, which we just discussed, and investing immediately following a conflict. And let's hope that we're closer to the end of this than the beginning, and this that does stay localized on the current front and doesn't expand into a regional conflict. How do you think about investing in as the volatility in the region decreases and we potentially come out of this? What sectors do you focus on? How do you think about opportunities coming out of this? I guess to ask differently, how do you think about making investments in recovery and in peacetime versus how you're investing today? And maybe we'll start with you, Erez.
Yeah, thanks. We're spending time on the day after. How would things change, and where the risks and the opportunities lay ahead? So in the central or base scenarios that we look for, we think that the economy would enjoy stimulus programs that probably will be launched, targeting the areas that were hit in the south, and also we are sure that there will be specifically infrastructure and programs, because to begin with, Israel lacks infrastructure relative to like developed markets and OECDs. There is a scope to invest in productive projects, and it could also jumpstart the economy and make the recovery faster. So that's one of the areas that we focus. We are also investing in private assets like infrastructure. So that is a key target for us going forward in the day after. Also, the defense sector in Israel. We believe that the events have shown that the interaction between high-tech technology that Israel has and defense needs, this combination, especially like we saw in missile defense systems and systems that are proven now in battle, that can be a huge tailwind for Israeli companies in exporting those systems. And they would also enjoy a favorable exchange rate that is maybe above the equilibrium like we saw. So that's an area where we focus. Another sector that we look to is the banks. The banks are a reflection of Israeli macro. And the starting point also here is relatively low valuation and conservative business model. We believe that if the government implements a more pro-growth oriented policies and budget, the major beneficiaries alongside with the market as a whole would be the banks. And the catalysts there for re-rating of the valuation can be quite significant. These areas are the main ones that we focus on.
Thank you.
So I guess, you pointed out the difference between investing during conflicts, which I guess for us, it's more looking for pricing anomalies, inefficiencies, some dislocations that are created by capital outflows, And again, taking those couple of first weeks after the war demonstrated sort of the magnitude of the opportunities that basically that were created. So that's that's sort of the example of investing during conflicts, which is essentially being quick, being, I think, flexible, identify opportunities on time, and act. Investing, I guess, for the day after, as Erez said, is somewhat more strategic, more structural, and I think it sometimes entails even some counterintuitive decisions. There's a lot of pent-up demand that could emerge, after a period of economic shutdown or economic sort of slowdown. Residential real estate could really come up stronger. Some of the service components of the economy, which are somewhat sort of depressed and shut down during the war, they could come up, very strong. And you look at COVID period as an example. There were some businesses that were literally ground to a halt and were very close to go out of business. And then a year later, they were prospering and making sort of record profits. So I think one of the considerations for us is to make sure that businesses are well capitalized, they have enough liquidity, and they can sort of withstand a couple of quarters of business slowdown.
Got it. Okay. Well, I'll end with one question for you each that you aren't prepared for, and then maybe I'll just check if there are one or two questions from the audience that we want to answer. So. Ron, maybe first with you, what could be a realistic bull case for the Israeli market over the next, let's call it 2 years? What do you think needs to happen in order for this market to really be an incredibly attractive destination market, for global investors?
So, I think in parallel to what we experienced, or the mirror picture of what we experienced this year, sort of a perfect storm, where, we had to sort of whether the judicial sort of reform, in a very modest sort of terminology, which was a huge risk factor here that really drove a lot of capital out of the market. So this risk factor is probably out of the equation. As long as the war is going to end, reasonably well, and that obviously that's open for interpretation. But we all understand that there will not be a major additional front in the north, then the economy could bounce back very quickly. There will be some new, let's say, government positions, maybe new resource allocation. So let's say overall of some of the government offices, judicial sort of reform out of the equation. The market is cheap to begin with, and that creates a very, very compelling bull case.
Thank you. And I guess on a related note, Erez, I've heard you speak in the past very eloquently and very convincingly about why the TASE and the Israeli market is an incredibly interesting destination for global investors. Would love to hear your perspective on, whether it still remains that, more now, less now, and why.
Yeah. We are, as we manage a global portfolio, I think although we are based here, we can make the global comparison quite well. And I believe when you look for really long-term investments, it's about the talent that is the economy has, and the innovation that this talent can produce. This is what built the Israeli economy and its strong fundamentals, and we think it is still here big time. Also, and not less important, the culture of risk-taking that we have in Israel that drives the innovation and the opening of new startups. When you combine this with free market economy that we have, I think it's on a global comparison, a very attractive setup, and we'll stay like this. And for an investor with a long-term perspective, it's an opportunity because valuation is quite low especially when you compare it to other markets. And maybe on a personal note, we have seen, the events, were really shocking, but alongside with it, a wave of solidarity that is unprecedented from the civil society, from volunteers, even from Israelis who live abroad and came back home. That's part of the story of the resiliency of the people and the economy, which enables Israel to bounce back very fast from crises like we had before. And I'm sure this will be no different. It might take a little bit longer, but we're certain that will be the path.
So some of the questions that are in from the audience touch on some of these things, and maybe I'll add something. First of all, I think Israel might be the only country in history whose population increased after beginning a war, which says it all, which is incredibly interesting. But one of the questions that were asked here from global investors is, I don't own enough equities in Israel, why not? So I'll try my best to answer that question, which is that I think there are some unique dynamics in Israel. There are some incredibly high quality companies that raised capital from local institutional investors, because there, of course, is a very high concentration of large capital and sophisticated investors in Israel. Those companies oftentimes didn't need to then tap the global markets to raise capital. In those cases, those companies had largely Israeli shareholders. In many cases, did not work with global banks, and so they didn't go to conferences and go on non-deal roadshows. They didn't have research coverage that was written in English, and so they didn't get the attention that other companies would have. And notwithstanding that these are incredibly high quality businesses, and there's lots of them, with strong rule of law and great corporate governance, very proximity to Europe, and businesses that tend to be global in their thinking. It's one of the reasons we spend a lot of our time bringing global investors into some of Israel's best companies, why we cover so many of them that are listed only in Israel in research. And so I think the answer to your question to the investor is that it's worth spending time looking at some of these companies that are under the radar, especially in markets that are so efficient today with algorithmic trading and arbitrage and so on. There are very few markets where you can find super high quality companies that are still under the radar for reasons that are more unique to this market, and not because they're not incredibly good businesses with incredibly good management. And with the Tel Aviv Stock Exchange and the Israeli Securities Authority all working tirelessly to bring more global capital into the markets and diversify the shareholder base of these companies, it's really an incredibly interesting market in which to find opportunities. I'll just see, Natalie, do I have time for one last question? Sorry?
Yes, Nati, yes, please.
Okay, so one other question that we're being asked here is, given the current market conditions, and this is, I think, for you both, once the war hopefully ends, valuations of medium and large size industrial companies will be affected. Do you think that these will be affected in a way that global investors will find investing in Israeli companies more valuable from a risk reward perspective coming out of this period?
Well, we view every single sort of business or sort of, prospective investment in a global framework, meaning that we benchmark each and every, stock versus its global peers. And then, we compare it not just on valuation parameters, but on quality, positioning, obviously corporate governance, management quality. And I guess these days, more often than not, you see the local, the Israeli companies, just because they are Israeli or because they're listed here, they're trading at a fairly meaningful discount. So I think that gives you the answer. And there's no reason to pick a stock or invest in a company just because it's cheap. It obviously has to qualify, and from that perspective, we run the process, and and a lot of times the companies that we identify here are not inferior. On the contrary.
And Erez, from your perspective?
Yeah, I'll add that besides the discount that Ron has mentioned, that we also see in our models, and we benchmark it also to the global peers. And we think that there could be a catalyst of M&A or inflows, sorry, from foreign investors that will close that gap. It could happen in the tech sector, especially where the comparisons are easier, and some of the companies already trade in the States, and it's easier for international investors to gain exposure. Some of the niche players in tech that publicly traded could be very attractive fit for US large cap tech, including in areas of AI and some of these really hot subsectors. So we think the discounting there and the catalyst might evolve in the coming months.
So with that, Erez Migdali from Migdal, Ron Senator from Sfera, I learn every time I speak to you both. I'm sure our audience did as well. Thank you for your unique and valuable perspectives. We appreciate all of your insights and look forward to the continued resilience and performance of the Israeli markets and of your portfolios. Thank you so much.
Thank you, Nati, Ron, and Erez. I would like to thank you all for taking the time and being here today. Our thoughts are with all those affected by the current situation, and we hope for better and more peaceful days ahead. In the eloquent words of John Lennon, let us dare to imagine a future where peace triumphs over conflict and where the dreams of unity and prosperity become our shared reality. We look forward to seeing you in person soon, in better days for everyone. Thank you very much. Bye.